This is the Do-It-Yourself Guide to Business Buying. Today we're talking about requesting financials. Welcome, business buyers. Now, what is our goal with this video, requesting financials? Well, I want to list the documents you should request from the seller or owner. And I want you to understand what they are and why you want them and need them. Let's say you line up a target company to buy. You want to buy Target Co. for $2 million in a leveraged buyout, meaning you're using borrowed money. What financial information on the business do you ask the seller for if you want to value the business and prepare an offer? Well, the documents we request are going to differ depending upon whether it's a broker deal or a direct approach deal. If it's a broker deal, we're going to receive a package of financial documents that were prepared by the broker. That'll get us 65 to 75% of where we need to go. If it's a direct approach deal with no broker, we're going to have to request the financials that we want to see individually, one by one. Obviously, there's a bigger burden on direct deals than there are on broker deals when it comes to requesting information. What documents do we request? Well, we need a balance sheet, we need an income statement, a cash flow statement. Those three make up the financial statements. We're going to want a management report on add backs. If it's a broker deal, we want a confidential information memorandum, often called the SIM. Of course, we need the tax returns. We want the aged receivables report. That is the money owed to us by customers, how much and how long. Aged payable reports. This is the money that we owe to suppliers. Again, how much and how long have we owed it. And an asset register where all of our assets are listed by serial number and the date of purchase. And of course, we don't always get them all right away. Maybe we shouldn't even ask for them all right away. We could do that piecemeal, maybe 2 or 3 different requests, or we could do it all at once. It's a judgment call. But do you have what you need to value the business, structure an offer, and approach a lender? That's what this video is all about. And that's why we collect the financials. Let's get more comfortable with financial reports. This video is not about analyzing the financial numbers. That's our next video. This video is about identifying relevant issues related to the financial reports that we're given by the broker or seller. And it's geared to business buyers who don't have an extensive financial background. So we're going to go through some basics. I'm going to highlight 7 points, and these are issues for you to potentially note or flag in an acquisition that are related to financial reports that you are given. Let's go through them. Let's start by answering this question. What financial information are lenders looking for on the target business? Well, there are different types of accounting and different kinds of information we can use. Let's take a look at them. There's financial accounting or public accounting, management accounting or internal accounting, and tax accounting that we use to prepare our tax returns. Let's take a look at them one by one. In financial accounting, we're preparing financial statements for external stakeholders, lenders, investors, regulators, etc. We have to comply with accounting standards. That might be GAAP, which is necessary for public companies, or international financial reporting standards for European companies and Canadian companies, or the financial reporting framework for small and medium-sized enterprises, which is the standard for private businesses. And third-party assurance is possible through a review or audit. What are the financial statements? Well, a balance sheet, an income statement, and a cash flow. All 3 of them are important. Management accounting, we use that to prepare financial information for management for decision-making purposes. There's no accounting standards that apply here. It's all internal. In fact, usefulness to management is about the only criteria that matters there. We want to be accurate, but there are no accounting standards. Tax accounting, that's the information we need to submit a tax return for the business. And we have to comply with accounting rules that are included in the tax code. And of course, it is country specific. We want to use financial information from all 3 sources in valuing and preparing an offer for the target co that we want to buy. Specifically, lenders want to see financial statements prepared by accountants following the appropriate framework. They want to see tax returns that are created by a tax practitioner for the target co business. And they want to see management reports as well. One might be add backs, which normalizes the earnings in private businesses. So it helps to understand different financial statements and what they are used for. 2, make sure you get a balance sheet. I mean, there are 3 main financial statements. Are we automatically given all 3 by sellers? The answer to that is no. I mean, we usually get the income statement, true, but the balance sheet is very often withheld, and we usually do not get a cash flow or a statement of change in financial position. I mean, all 3 of these statements integrate together, so it is nice to have them all, but we definitely need both the income statement and the balance sheet. And if they don't give you a balance sheet, you do need to request it. Why do we need to see a balance sheet? Because, to be frank, a lot of sellers and brokers do push back against providing one. Well, here are some reasons we need a balance sheet. Number 1, we want to understand the financial position of the business. We don't want to buy a business unless we understand the financial position of that business, which we get from the financial statements, including the balance sheet. But there are specific questions we're wondering about. Are customers owed money, which shows up as deferred revenue or customer deposits? What assets were on hand to generate those earnings? What assets can we borrow against? What creditors are owed money? We need to see a balance sheet. So if the seller tells you the balance sheet is not relevant because no assets are going to be included in the sale, which is very often what they say, we respond on why we need it from the previous slide, and we remind them, right? The balance sheet is not a bill of sale. That's the way a lot of sellers treat it. The balance sheet just includes what assets are included in the sale. Very often, in this situation, none. But we still want them to go on the record, put it on paper, and give us a balance sheet. Make sure the balance sheet is current. Income statements cover a period of time. Balance sheets are as of one calendar date. And of course, cash flows cover a period of time as well. The particular calendar date on the balance sheet does matter. If this is our fiscal year start and fiscal year end, the income statement covers that entire fiscal year. So income statements cover a period of time. Same with cash flow statements. They cover the full fiscal year and a period of time. But balance sheets are different. They're calculated as of one specific calendar date. We want to make sure that the date on the balance sheet is the ending date of the income statement. In other words, we want to check for date matching to see that the dates match up. And we also care how current the balance sheet is. The balance sheet date should be less than 30 days ago. Next, we want to find out whether your financial statements on the Target Co. have been compiled, reviewed, or audited. I want to talk about financial statement reporting, specifically assurance. When it comes to income statement, balance sheet, and cash flow, financial statements that are prepared by an external accountant are either audited, reviewed, or compiled, and there are huge differences between them. And so you do want to find out which one of them applies to the financial statements of the Target Co. that you're working on. Audited and reviewed carry different levels of assurance, while compiled carries no level of assurance whatsoever. I mean, lenders, investors, and even you as a buyer want to know two things. Number one, what is the financial position of the business? We're going to get that from the financial statements, the balance sheet, the income statement, and the cash flow. But we also want to know, how assured can we be that it's accurate? And so financial statements can be subject to a third-party audit or review to determine their reliability. So financial statements prepared by external accountants are either audited, in which case they carry an opinion, and that opinion will be one of these three: clean, qualified, or adverse. And of course, that's where the assurance comes from with audited statements. If they're reviewed, there's no opinion given per se, but limited assurance is provided. We're going to see how that works in a second. And if you have compiled statement, there's no opinion given, and there's no assurance provided whatsoever. This might be overkill, but I want to look at what accountants do at each level, just give you a very superficial look. I think it's important for you to know what assurance is standing behind the financial statements that you're looking at when you're preparing an offer on a target business. So if accountants audit the financial statements of the Target Co., they're really doing a deep dive. All the accounting-related items are observed, tested, confirmed, compared, or traced, very hands-on. To determine whether the financial statements are free of misstatements, that's a big job of an auditor. They're always on the lookout for mistakes. Evaluating internal control system, auditors ask a ton of questions. They'll perform analysis on accounts with unexpected variances. Auditors get very curious about the unexpected. They physically observe the inventory account, again, very hands-on. They'll confirm accounts receivable and other accounts. The key concept with an audit is it's a deep dive. The end result is you get an audit opinion, and it will be either a clean opinion, a qualified opinion, or an adverse opinion. Obviously, we are looking for a clean opinion, and then the comfort letter that comes with the statements will say something like, in our opinion, the financial statements fairly present in all material respects the financial position of the company in conformity with generally accepted accounting principles in the United States. Now, of course, if you are in a situation where you're using a different framework than GAAP, right, that framework will be plugged in place of generally accepted accounting principles. But that's the ideal. We want a clean opinion. A qualified opinion, the precise opinion will differ depending on the issue, but it usually indicates that some GAAP provisions were not followed in one specific area, but otherwise the statements do fairly present the financial position of the business. That's going to be an issue for a buyer for sure. They're going to ask some additional questions if they're trying to buy a company with a qualified opinion. An adverse opinion is much more serious. It indicates that departures from GAAP or the framework were significant enough that the financial statements simply don't fairly present the financial position of the business. A definite red flag. We're not buying businesses that have adverse audit opinions. But of course, we don't see many businesses with an audit opinion at all, as we're going to note in a second. That covers audited statements. What happens when accountants review financial statements? Let's take a look at that. It's much more analysis-based. Review procedures are way less intense than audit procedures, way less hands-on. They're basically looking to see if any modifications are needed for the statements to comply with GAAP or whatever framework they're using. It's a lot more analytical and less hands-on checking and observing of source materials. You might do a ratio analysis looking for anomalies or look for other plausible relationships between different accounts. You're going to analyze comparison to determine whether they're reasonable, etc., etc., etc. So what's the end result when they're done? Well, you don't get an opinion if the financial statements have been reviewed. Instead, it provides limited assurance and basically says something like this: the accountants are not aware of any material modifications that would be needed for the statements to comply with GAAP or whatever framework you're using. That covers reviewed statements. What happens with compiled statements? If accountants compile your statements, no assurance of any kind is given. They basically present company financial information in the form of financial statements. So no opinion or assurance is provided regarding those statements. In fact, the accountant doesn't even have to be independent. It can be an internal accountant. That should be disclosed if that's the case, but there are no standard compilation procedures. Notes are optional. It's a bit of a free-for-all. And here's the issue. They can look like reviewed or audited statements, but in fact are very different because no assurance of any kind is given. And so the end result of a compilation, well, they just take the financial information from the company and organize and arrange it to look like financial statements, and that is it. There is really nothing more to it. You aren't getting any assurance at all with compiled statements. So how often do we see each audited, reviewed, and compiled statements? If we have public companies and private companies less than $5 million in revenue, when it comes to audited statements, all public companies are audited. It's the law. They have to. They are compelled. Private companies, I would say it's less than 1%. You're not going to see reviewed statements with public companies. Even in private companies, it's less than 5% of the time. Compiled statements? No, of course not with public companies. But in the private company market, it's 95% plus compiled statements. And so this is really two different worlds, and I think people who are buying businesses need to understand that. If they work for a big company and you have auditors running around all the time, you're thinking, oh, these statements are pretty reliable. Not so in the private company space. You need to do your own checking. The statements might be fantastic. We're not saying everybody in here, is running a crooked operation, not by any means. Point is, you're going to have to do the checking. No one's doing the checking for you. So why are financial statements prepared? They are prepared to present the financial position of the company to outsiders. And not all financial statements are created equal. That's a mistake new business buyers sometimes make to think that they are. They think a balance sheet is a balance sheet. One is as good as another. That is not really true. In reality, there is a confidence hierarchy that people have in financial statements that are given to them. Here's my informal confidence hierarchy that I use when reviewing financial statements, with the reports that I'm most confident in at the top and the reports that I have the least amount of confidence in at the bottom. Here's my list. At the top are audited statements by Big Four accounting firms. That is the gold standard. Closely behind that are audited statements from a CPA in good standing. Next, reviewed statements by a CPA in good standing. After that, we're looking at tax returns that are prepared by a tax practitioner. Number 5, compiled statements that come from the accounting software of the business. Then compiled statements that are prepared by management on third-party software. And then the compiled statements that you find in the confidential information memorandum or the SIM that are prepared by the broker. That's my list. I have the most confidence in the item at the top of the list and the least amount of confidence in the item at the bottom of the list. Now, we've already said that the top 3, we've already mentioned in this presentation that we rarely see them in reality. So let's go down to number 4 and 5. Tax returns and compiled statements prepared by a tax practitioner and statements from the accounting software. Lenders will accept those. That's what they want to see. They don't want to see one or the other. They want to see both. They want to see the tax returns and they want to see the financial statements from the accounting software. So if you provide those to the lender for underwriting purposes, you should be in good shape. What about the bottom 2? Compiled statements prepared by management on third-party software, Excel, Google Sheets, Word doc, whatever, or compiled statements you find in the SIM. Lenders won't accept either one of those. So if you're trying to get a lender to underwrite a loan for you to buy the business, you can't expect them to make an underwriting decision based upon 6 or 7. They won't accept them. In fact, that sort of segues into number 5, which is that we need compiled financial statements generated from accounting software. So let's ask the question, where do financial statements come from? Well, if you have audited statements or review statements, right, you get a package from the external accountant. It's got an opinion and an assurance letter. It's self-contained. There's a title page. It has notes. Yeah, it's a thing of beauty. Everything looks ship-shape. If you get compiled statements from an owner or a seller, it's the Wild West. It could be almost anything. It could be fantastically presented, or it could be an Excel spreadsheet that you can't really understand, or Google Sheets. I've seen financial statements with handwritten annotations on a Word document. I've seen them on PowerPoint slide decks. And of course, we see them in a confidential information memorandum. For underwriting purposes, none of these really cut the mustard. You need financial statements that are generated from the accounting software of the business. That's what they're looking for. Whether it's Xerox or QuickBooks doesn't really matter. Point is, when you're sharing compiled financial statements with a lender, only send them financial statements that were generated from the accounting software of the business. 6, we're going to take a look at whether the financial statements that you receive from the seller are cash or accrual statements. I mean, compiled financial statements can be either cash or accrual. Cash doesn't follow GAAP. Accrual does. With cash statements, cash is received is when the revenue is booked. On accrual statements, when the goods or services are delivered is when the revenue is booked. Same with expenses. When the cash is paid, that's when expenses are booked with cash accounting. With accrual accounting, when the goods or services are received is when the expenses are booked. And cash is used mostly for tax purposes. I mean, there's nothing really wrong with cash statements. If a small business only has a need to keep financial statements for the purposes of paying tax, and they pay tax on a cash basis, nothing wrong with that scenario at all. And accrual accounting, of course, is normal mainstream accounting. So here's the issue. The balance sheet is often missing the accounts receivable and accounts payable when we do cash accounting. You will find the accounts receivable and accounts payable on a balance sheet with accrual accounting. Why do we care? Well, we want to make sure that we know which method is used, because in B2B businesses that use cash accounting, if no accounts receivable appear on the balance sheet, right, we don't realize that we could potentially borrow against them because they exist. They exist, they're just not on the financial statement because the financial statements are prepared on a cash basis and not accrual. But we may be able to borrow against them, so always check. That's the point I'm trying to make. Next, the confidential information memorandum, what it represents and issues that we need to potentially flag. It's a document you will receive if a broker is involved in your deal. All right, let's take a look at this document because it can be confusing to new business buyers. And the reason why is because it sounds like other documents that also use that word, memorandum, like a private placement memorandum. That's a disclosure document. It's a legal document. It was prepared and signed off by a lawyer, and it was prepared for legal compliance reasons to meet statutory requirements. Offering memorandum is exactly the same thing. Same document, they just use different names in different jurisdictions, but it's also a disclosure document, legal, prepared by a lawyer, and done for legal compliance reasons. So now we have this third memorandum, the confidential information memorandum. And we're wondering, is it like the other two? Is it a disclosure document? No, it's not. Is it a legal document? Not at all. Was it prepared by a lawyer? No. Was it done for legal compliance reasons? Also, no. It sounds like the other two, but it's completely different. A SIM is actually a marketing document that meets no disclosure standards at all. It might be really well done and have fantastically accurate information, but it's all dependent upon the broker that's involved in preparing it. So there's a wide spectrum of quality when it comes to SIMs, meaning buyer beware when it comes to the SIM, and don't get confused about the reliability of information in a SIM. It's a broker-prepared document. It's a sales document. It's not a disclosure document. And the bottom line is that lenders don't accept financial statements that are presented in a SIM. So in summary, even if you outsource financial analysis, you need to understand the financial documents that are needed for that analysis. And many business owners in this space, we have to be upfront. They really have no formal need for financial reporting outside of preparing and paying their taxes. And for that reason, financial reporting can sometimes be slim pickings when we're targeting these less than 5 million smaller businesses. Nevertheless, solid financial information is needed. We need it to screen the deal, to value the business, to structure the offer, attract investors, and attract lenders. So it's an important part of the mix, and we need this information for sure. So to prepare for financial analysis, you need to understand financial reporting, even when that analysis is outsourced. That's the reason we put together this module. So let's get after it. This is the Do-It-Yourself Guide to Business Buying. Today we've been talking about requesting financials because we want to learn and grow as we go. Thanks for watching. We'll see you next time.